Smart 24 TV, and we mean business 24 hours, 7 days a week. This is the point where we analyze economic policy. Today I'm with Dr. Clark Kisembo, and we are talking the risk management in the financial sector, taking the case study of what is currently happening in the global finances, especially what seems to be a crisis currently in the banking sector. Now, Dr. Clark, you've already shared about why we should be concerned. You didn't call it worry, but probably the concern that what's happening globally could actually have ripple effects here. And you've clearly shown that we need to act quickly if at all we are to actually stay put and resilient amidst what is coming. But when you look at, for example, what the US government did, you wouldn't expect that probably of a small economy like Uganda, having deposits worth over 212 billion refunded by government. That is a very huge burden. And Joe Biden said it has nothing to do with how much money you have with the bank. You're going to get fully your deposit. I'm wondering if that could be the case in Uganda. If any simple bank, even the smallest banks we have here, collapsed, would our insurers, what we call the Deposit Protection Fund, be able to handle such a case?
So I'll start by saying that it is a very good initiative that in Uganda there is a deposit protection fund. That gives a level of confidence to depositors and also gives a reason for financial institutions to collaborate with the central bank. Because remember, they have a deposit there, which is more like collateral. To be a bank, there's a certain amount. But that amount may not be enough because it is collateral to get a license, and comes in the Deposit Protection Fund. I think it's just about a year or two that it has raised its threshold of what it can compensate depositors to 10 million, right? It was about 3 million. Now, President Joe Biden taking his executive power directive, because the president can take that by the Constitution of the US. He says that no one who is affected by the collapse of this financial institution is going to lose all their money, because the replica of the Deposit Protection Fund in Uganda, it is I think the national
FDIC.
Yeah, so FDIC also has the same model, but it is at a threshold of 250,000 US dollars, right? 250,000 US dollars in a country like, if we turn it to shillings, that's about 10 billion. 10 billion Uganda shillings. We are talking about 10 million Uganda shillings to be compensated. Now, if I have 100 million in the bank and the bank crashed, the most I can get is 10 million from the Deposit Protection Fund. You get it? You're following?
Yes.
Does our president have the mandate to give same instruction or directive that nobody, we have had banks close in Uganda. You heard of Greenland?
Yeah.
You heard of Sembule Bank?
Yes.
You ever heard of
Nile Bank?
Nile Bank, this Crane Bank?
Yes.
Yeah.
Afribank, Afriland.
Yeah, all these banks. The question is, to date, have they fully compensated all those depositors who are there? It could be yes, it could be no. Chances are no. Now, the issue is that would the president, President His Excellency Yoweri Kaguta Museveni, come out and say that Mr. Sebali, you have 100 million, it's all going to be compensated. He comes on TV, State House, addresses the nation and the world and the globe that you're going to be compensated. What if we are 100 of me and you who have 100 million in a specific park? Does Uganda have the capacity to do that? You need to check two things. Uganda's debt ratio at the moment. Uganda's debt ratio at the moment does not even allow it to offer sovereign guarantees to get a loan. That's where Uganda stands. If you can't offer a sovereign guarantee, then you're a sovereign entity, but you can't guarantee a loan. You see, you're so indebted. Now you're so indebted, how do you come and start giving a directive that all of you will be compensated? I don't think our president is so that he's so intelligent that no matter how many advisors who would like his favors around him would tell him to go and make that statement, the president of Uganda can never go and make such a statement. People may say he's old, but he's so intelligent to know that history has lessons to learn, that Uganda's debt ratio can't allow for that. GDP, when we're in COVID, we went down from a targeted 6.5. We sloped down during COVID to something like 2.2 GDP. It has now raised almost 5.6, maybe even 6 now by the time we're on air. This 6% GDP, is it something to celebrate? Yes, that we've tried. But is it something, percentage that you can go on TV and say that, like Joe Biden says, all of you depositors, you're going to be compensated your money fully. You're not going to lose your money. And he's like, you, is it the FDIC? Yeah. Don't even question my directive as president. The Treasury of the United States of America has the money to pay out all these people. Does Uganda have those reserves? Would it be disindebted? Now, I'm bringing out this to show, to open up the mind of who is out there, to understand that the two contexts are quite very different. But as we celebrate 6% gross domestic product, yeah, GDP, we speak it. I am a financial economist, but I'm also a development finance technologist. I like to simplify complexity and break it down, that when I go to a person in Chikubo, right, Chisenyi, Katanga, talk about the bottom of the pyramid, they'll be able to comprehend. Now, over 90% of Uganda's population I'm not even sure whether we have a middle class in Uganda. Because there's a certain rich 5%, then there's a certain 95% with a pretentious
middle income.
I have a car, yeah. I have a job, I have a salary, I get a salary. If I'm fired from that job, I have nowhere to fall back.
I'm sure that's less than even 95.
Yeah, so there's that pretentious middle class, which at times I ask people, if you're fired from your job, how long would you stay without another job and you can survive? Driving your car, sleeping in your house, paying your bills, and they're like, they don't think 6 months could go. Now you don't call that a middle class. Maybe academically they are educated, that's good, that's a middle class. But let's say there's a 5% rich people, then there is a 5% pretentious middle class, then 90% of people who really need a hand, who need structures, programs. I hear of the parish development model. I heard of a MIOGA, I heard of NADS. These are government programs. Yeah, but let's say the private sector in Uganda is so weak, it's too shaky. You can't even compare it to Kenya. I lived in Kenya. I started trading in stocks and shares. I think I was about 20. Which 20 here in Uganda trades in stocks and shares? So it is, when you look at Uganda and Kenya, you're like, we are just joking here. Now GDP means that the income of the 5%, which is the 95% revenues of Uganda, plus the income of the 95%, which is the 5% revenues of Uganda, add them together and divide by the 45 million people population. Then you get a percent times 100, that's the percentage. Me who's earning 10,000 or 5,000 per day, if you count me as part of this 6% GDP, it's like you're terribly mocking me. Because there's somebody who can afford to go to a club, to a bar, to hold a wedding function, 500 million, they can go every day to a bar and they'll spend close to 5 to 10 million. I'm hustling to find 5,000, 10,000 shilling. That's the 90% of Ugandans. Now, tell me that this deposit protection fund can come and can even advise the president to make such a statement. It can't happen in Uganda. Maybe, let's be optimistic, futuristic, that probably I have a daughter who's 7 years. Maybe when she grows to 25, I can believe that. For now, no. No.
Dr. Clark,
yes, sir.
When you look at the SVB's case, still looking at SVB,
yeah.
Some of the economists are criticizing Trump's administration for bringing down rolling back some of the policies like the Dodd-Frank policy. The act was actually signed into law by President Obama in 2008 after the financial crisis that hit the US. And the Dodd-Frank policy or act required that banks with at least $50 billion assets, which are considered systematically important, were actually to undergo annual Federal Reserve audits, or what we call stress tests.
Yes.
And these were to maintain certain levels of capital as well as plans for living well if they ever failed. Now, SVB's chief executive himself, Greg Becker, who you just mentioned there, argued before Congress back in 2015 that the 50
I remember. Yeah.
That the 50 billion shillings was unnecessary. And his bank was likely to sustain and was actually risk-free. That's what he called it. And does not present any systematic risks. This was him just 7 years ago, probably. Now, Trump said in the new bill, when he came into power in 2018, that there was a long way towards fixing the Dodd-Frank Act, and he called it a job killer. You know how he used to throw words around. He called it the job killer. But when you look at what he did, he rolled it away from 50 billion, I think, to over 250 billion. That is a stretch.
Yeah, about that 250. That's the range.
So now banks like SVB, which were currently below this, unable to actually explain. The Federal Reserve is there, and they were unable to actually do this stress test because SVB was not at that point, the threshold, the 250 billion. It was still at 212 billion,
Yeah.
now collapsed and gone. Could this actually be one of the things that led to the collapse? And should banks and other financial institutions, not just restricting ourselves to banks,
Yeah.
be regulated in this way?
So the principle of finance and financial, let's say, sustainability of finances making finance. Yeah? Money working to create money. The principle is risk. If you have no control of risk, because remember, financial institutions used to combine risk and compliance as a department. There's a time I used to speak out and say, what's wrong with these financial institutions on this continent? How do you mix risk and compliance? These are two different things. Risk is a huge monster of a financial institution. Compliance is also very huge. Many have separated them now, but back then it was something which was just merged up. Now, I remember, I think I must have got goosebumps because I don't really remember which country I was in. Maybe I was in the US or, but I know I wasn't here when Dodd-Frank, even a statement of lift it came out. You know, as a financial analyst, not only analyzing financials which are done by another, but as an architect, you can create a financial structure and a model for a fiscal and monetary policy. You very well know that some of these financial institutions do not have the necessary prerequisites or asset base to hold a certain amount of money or to trade into it. So when it came to 50 billion as a stress test, that was already good enough. And let's leave it in America, because in Africa, no. 50 billion, a bank, 50 billion stress test, maybe 50 billion shilling. But US dollars, and I don't want viewers out there to think that I'm undermining the financial sector in Africa. The financial sector is so strong in Africa, just that perhaps those managing and governing it are salary earners. I wake up in the morning, go do my work, earn my salary, I go back home, my kids go to good schools, I sleep in a good house, I drive a good car, and that is it. There are some of us who are patriotic to this continent and the nation, that even if you didn't pay me, I'll go to the central bank and tell them, which economist brought up this policy? This one needs to be fired. You know? But let's say, back to the point, 50 billion. 50 billion when Trump, His Excellency, former President Donald Trump, came and lifted it, and they said, no, those ones, 50 billion, the stress test. One is attacking the personality of your predecessor, that maybe his policy was not astute. But two is that you're protecting your interests too. Remember, President Trump is a businessman. That is where the US actually, at times when it speaks, I'm like, You speak, but African countries have gone past that. This business of conflict of interest. You're the president, sitting president. You're running businesses. Who goes to audit your companies? Can the taxman you appointed as the head go to start checking your taxes? So when they talk, I just say Americans talk, you Western talk, but Africa will be Africa. But let's say one, water down your predecessor, who was a very intelligent man, President Obama. He knew that banks are not stable. SVB has gone down with 186 banks. You're looking at SVB alone. 186 banks.
Regional banks and international banks.
Yeah, regional and international banks has gone down with 186. Yeah. When President Biden is saying that we are going above the threshold, he's not just speaking to Americans, he's speaking to the world. So the depth of this is that when it is put to 250 billion, which means that you have created untouchables who are going to even start taking people's deposits, people's investments, money without a clear forensic or financial check and audit of their worth, what is their asset base, what is their backing, what if they went down, what would happen? Same as the Lehman Brothers, 2008, 2009, the credit crunch.
Basically, it's gambling with a lot of money.
It's gambling with a lot of money. It's like you got all this money, and I won't name clubs because I'm also an ardent sports person. I love soccer, but you see that the performance of one club has been very good, consistent. Then one which is under relegation, you say that we are putting $1 million should this relegation club win the game. The whole pool of investors who have not thought twice will put the money here. But $1 million, and you're talking about $50,000 on this one, which has an upper hand. When this one wins, all those who went for the $1 million have lost. A bubble has burst. So that's why you say that at times, this so-called float money is just a medium of transacting. Yeah? Money is a medium of transacting. What holds credibility and strength of money is the backing of assets. Gold reserves, for example. What are your assets? Do you have industries you're investing in? Do you have buildings which belong to you? You know? Recently, I remember one of the banks in Kololo. I don't know how it happened and how they didn't think through it. You know, there are things in Uganda which can really surprise you. You build a building in Kololo, you know your head office will never cover the building to full capacity, which means you need to let out. Yeah? To let out the other part. But you don't register a holding company for real estate from which even you, the owner, are going to rent. In the banking laws, you can't rent, you can't let to anyone else. So the building is there all glamorous. Very wasted space. You get it? That is the thinking here. That there are things they take for advantage. You build a whole house belonging to a whole religion, one of the largest religions, and you put it in the names of the bank, who is going to let you to put rental clients on that building? Let's say 18 floors. You're going to occupy just 2 or 3 floors.
Definitely.
That is loss.
Yeah.
You're losing. You're losing. But the thinking behind that is what I normally question. Who thinks for financial service providers in our countries in Africa, and not only in Africa, but the world over? Because remember, it does not discriminate. The credit crunch started in the US. The Lehman Brothers. SVB, it is in the US. The problem is, it comes down.
Yeah.
Uganda still depends on donor funding. Where does donor funding come from? Taxes of the people of that nation. When the people of that nation are affected, which means that the donor funding is cut down.
Okay.
That's where, I don't know whether you had that question, but I'll raise it. That's where I say that financial service providers in Uganda, be careful how you do your business, because very soon, what we call 30 banks and numerous MFIs in the next 10 years may not be in existence.
Dr. Clark, right there, we're going to take a very short breather. And when we return, I want to ask you about how the financial institutions and the MFIs, like you've mentioned, can balance the need for risk-taking and innovation with the need also to manage risk and protect their clients' investments. When you look at SVB investments, they invested a huge amount of money in treasury bonds.
True.
And unfortunately, these were longer-term treasury bonds, and they bought a lump sum of them. And because of the increase in the rates, remember at that time in COVID, all the rates were almost at 0%.
Yeah, they were almost zero.
And the Federal Reserve started raising the rates, and then the value dropped.
Exactly.
And they lost a lot of value.
You got
And yet, we would think treasury bonds are safer investments. Where is the line between risk-taking? Because, of course, like you say, the higher the risk, the more the returns. And these banks cannot keep on looking at this money without investing it. But how can they do it prudently with the protection of the clients in mind? My name is Anthony. You're watching The Point. I'm with Dr. Clark. We are taking a very short breather. We return shortly. Stay with us.